analysis, if we jump into this, you can see that we have basically subtopics inside of the larger topic. So I've covered things like top-down analysis. It's just a way of collecting more information. So this is a trading style where you would use high time frame, then medium time frame, then low time frame, like using the daily into the 4 hour and then into the 1 hour to find trades. As you can see, this gives you more information than simply trading one time frame. So incorporating things like this into your trading is one of the big steps towards collecting more info, doing better analysis, and winning more trades. Now, the second thing I covered here is technical concepts. Basically, I believe you can win at trading with pretty much any approach, right? You could even win with a indicator combo strategy if you tried hard enough. Although I don't think it matters what technical concepts you trade with, I do think you need to be clear with the elements that you are indeed going to trade. If you're going to trade support and resistance, then trade it. If you're going to trade supply and demand, then trade it. If you're going to trade trend lines or indicators, then just trade it. What you can't be doing is trading support and resistance today and then supply and demand tomorrow, because that shows that you clearly have no system. And what you're doing is pretty much just gambling into each setup. Remember before I said you're trading on hope? Well, that is exactly what happens when you're mismatching these concepts, right? If one day you've got a trend line setup, the next day you've got a supply and demand or SMC setup, basically your problem is that you are unorganized and unsystemized. And that means you can't make your trading repeatable. If you can't make your trading repeatable, well, then we can't bring all of these elements and turn them into this. Right? Which is what we need to do in order to succeed. So whatever technical concepts it is that you're going to trade, just make sure you stick to it consistently. And then the final thing I wanted to cover here is trade management. This is pretty much how you nurture a trade when you are in it. So we need to think about things like take profits, where they're going to go, and stop losses, and what you're going to do with these as well. Because maybe in your system, you could move your stop loss to break even when a trade is running in profit. That might be a profitable thing for you to do if you tested it over the long term. But a lot of people don't even consider this stuff, right? The management, because it's not as exciting. We just want to get into trades, right? That's the exciting part. But really, the money is made in actually looking after the trade when we've taken it. So trade management is actually incredibly important. Now, as I've just covered, you can see that when we go through these different ways of improving our trading, the main goal is to make it repeatable and turn it into a system. Right, we want to make sure that we are following the same rules pretty much for every single trade we take, right? There could be slight deviations in analysis, but it's always going to be the same concepts. We're always going to make sure to get the most information that we can, and we're always going to make sure that we have a solid management process. So when we get into a trade, we can get out of it profitably in the future when that time comes. And we pretty much have the same goal when we move on to risk management. We want to systemize things here. So the first thing to cover is risk to reward. If you don't know what this is the best way to trade for long-term success, in my opinion. So risk to reward is classed as a ratio. So your risk to reward here, for example, would be this 1 to 3. This means our risk is 1, our reward is 3, which basically means every time we risk $1, we are trying to return $3 if the trade wins. This allows us to win even if we only win half the trades we take, right? So that means we can be wrong half the time and we can still make a considerable amount of money. Let me show you an example. If we had a 1 to 3 risk reward ratio and we won only 40% of the trades that we took. So 40% win rate, 1 to 3. Let's say we take 100 trades. 60 lose, 40 win. On the 60 that we lose, we are going to lose 60%. So now we have minus 60%. But on the 40 that we win, because we've got a 1 to 3 going on, we're actually going to win 120%, right? So we have 40 times 3 and then 60 times 1. So now we have 120% minus 60%, which is going to generate an overall return of 60% over 100 trades, which means average of 0.6% profit per trade, right? Which means every time we take a trade, we are basically making 0.6%, whether it wins or whether it loses, right? This averages out to create this 0.6% profit per trade, which is an awesome thing to know, because if you can just consistently do this, well, now you don't even have to be right half of the time, right? You can be right only 40% of the time, and you're still going to make 60% every time you take 100 trades. Let's say you take 100 trades over the span of a year. That's a 60% return over the year, which is around 5% per month. A very healthy profit and something to be very happy with. So you can see the next thing I noted on the risk management section is just an understanding of the probabilities. I've just showed you those probabilities, so it's just a consideration of this. The other thing to consider is that you can remove your ego from trading. Now, this also kind of directly correlates into some of the mindset-based stuff. Basically, you don't need to be worried about being right and stroking your ego if you know you can win even when you're wrong, okay? So just understanding these, it's going to be related to the risk reward, the win rates, and then, of course, ego-related things, as we've just said, right? Get these things right, and you will do a lot better. And as I say, this does pretty much link into psychology as well. Now, the final note I've got from risk management is risk per trade. So we want to make sure we are risking the same amount on every trade we take. I like 1%. You could do, at the very highest push, 2%. But you could also do, and I quite like this one as well, say you've got a funded account, 0.5%. That's going to keep your capital safe. Now, the main rule with your risk per trade is just to make sure, regardless of what you choose, you keep it the same, right? Because let's say we go back to that 40% win rate example, but we were mismatching our lot sizes, right? We have 60% of losses, but let's say they were all at 2%. Well, that would be minus 120%, right? If we also had 2% on the 40% of winners, so we were making 6% per trade, well, now we would actually make 240% across 40% of winners. But let's say the 40% was actually at 1% risk. Say we got unlucky. All of our losses were the big size ones. All of our wins were just 1% wins. Well, now we've got 1% times 3, so we have 120 here. So we've basically got 40 trades out of 100 times 3, because they are 1 to 3 trades. We have 120% return. But we have 60 losses at 2%. So we have 120% loss. So now we've done an entire year of trading and we make 0%. Obviously not great, right? So this is why you need to keep the risk per trade the same. Either choose the 1% or choose the 2% or choose the 0.5%, but don't go on a case-by-case basis. Your risk per trade must remain the same for every single trade that you take, okay? So what we've just covered here has once again turned into a system. So now we've got a system for our technical analysis. We have a system for our risk to reward. And we'll just briefly cover mindset and psychology. This is going to cover things like understanding that probability and ego. Also just remaining patient and waiting for trades that are good. Staying disciplined enough to follow these systems that you've created here for risk control and of course for technicals. And then keeping a long-term focus is just about keeping your eyes on the bigger picture, right? We want to make sure we are looking over a 2, 3, 4, 5 year span, not just looking at making a couple $100 today, because that is not going to help us in the long term. So everything that I've just showed you comes together to create a system. This is a repeatable plan that will cover a bunch of different aspects. We've got here mental factors, our risk control systems, our analysis process, the entry criteria we use to get into trades, the trade management process, the backtesting process, the journaling process, the capital management process. So obviously we know what these are, what these are, what these are, what these are, and what these are. But we've also got some extra elements. This is how we validate our trading. This is going to become very relevant soon when I get into that 4-step process. The journaling process is how we improve. So backtesting is where we trade in a simulation, right? We use a software that will allow us to test our systems out in real time using past price data. There is no risk here, but we can collect a lot of information and also build our trading experience as well. Even though we're not trading live, we get to look at hundreds of different hours and days worth of chart price action to understand how the market moves. Journaling is where we track the trades that we take and then we review them. And when we review the trades that we've taken in the past, we get to see areas of improvement. We get to see areas where there will be lots of losses, right? And then we can try and eliminate the reasons for the losses. Now this all together will create your base trading success, but we need to create lasting success. So pretty much everything that we've covered in this area is going to be crossed over and continued onwards. So we will continue to do backtesting. We will continue to do our journal reviews to make incremental improvements. We will make sure that any money we make, we are making smart use of it. So we are going to try and scale this capital. We're going to save and we're going to invest this capital to make sure that aside from trading, we have some money, some wealth, right? You don't just want to gamble it all in trading. It's one way to make money of many. There are better ways to preserve wealth, and this is where that smart use of capital is going to come in. Obviously, I also believe you should continue studying. You don't have to continue studying other people's work when you're profitable. I don't do that now, but I do study my own work. I do study my own charts, my own backtesting, my own results, anything that I can to give me a further edge or reverse engineer things in the markets to try and understand how things are changing and how we can continue to improve based on study. And then the final thing is just accountability. So be real with yourself and stay focused. Okay, that's pretty much it. And if you do all of these things, you are going to create that lasting success that we've talked about. So following on from that blueprint that we've covered, you're probably now starting to see the key to successful trading is through systemization, allowing your strategies and systems to do the heavy lifting for you to balance the profits and losses that you are inevitably going to take. An understanding of the importance of trading systems and strategies, along with an understanding of the math behind successful trading, is exactly what you need to start making massive strides in the right direction towards your progression. You will never become a consistently profitable trader without a trading plan. You need one. I'm going to help you set one up. So we are going to look at what a trading plan is, what a good plan includes, a trading plan that you can use, so we're going to test one together in real time, how to test your plan, it's going to be weaved into that, and how to validate your plan so that you know it is profitable. So first things first, what is a trading plan? Well, a trading plan is simply a systemized list of rules that surrounds your analysis and your risk management, turns it into a process that you can continually repeat every time you come to the markets. And a successful trading plan is going to cover three core elements primarily. First of all is our analysis methods. What kind of macroeconomic or technical concepts will you be using in your day-to-day trading? And what will that look like? Such as top-down analysis, different entry criteria, the actual concepts you'll use, whether that's trend lines, support and resistance, supply and demand, Wyckoff, whatever it may be. And the analysis needs to cover everything from the very beginning all the way through to